Software firm ServiceNow dropped more than 15% last week after its earnings results. The stock is back up a bit since that initial drop, but it's still down around 10%. And overall, it's down more than 60% since its all-time high in January 2025. So in this video, we're going to cover the stock and discuss whether or not it's a compelling buy at these discounted prices. And as always, this is not personal investment advice. These are just our opinions based on the research and the analysis that we've done. All right, so let's start with what the company does. ServiceNow is in the productivity software space. They sell a full-service business operations and administration platform that allows companies to manage all of their workflows ranging from IT ops to HR to customer service, finance, and security, all under one customizable umbrella. The platform essentially automates all the tasking, tracking, and reporting systems necessary for all these various functions of a business to communicate and operate with each other seamlessly. You can think about ServiceNow like Salesforce or Atlassian, except that Now's strength is that its platform extends to cover the full suite of business operations, something that Salesforce and Atlassian don't do as well. To think about it another way, imagine a tool or software that can see just about anything in a business, from servers to hardware to devices to personnel and tasks, and that can also understand each of these components and how they relate to each other. That's basically what ServiceNow does. Over the last few years, they've also added a Gen AI layer on top of the platform, which is known as Now Assist. Now Assist is their AI engine that proactively handles rote tasks for companies. And what makes the AI layer so powerful is all the data that those models have been trained on. All that past data and all that learning is a true competitive edge that is very hard to outcompete. So overall, they have an incredible and extremely valuable product. And it's a product that's actually used by 85% of Fortune 500 companies. They're used by Walmart, Amazon, NVIDIA, and even Microsoft. And that's actually saying something, right? Microsoft competes with ServiceNow, but they still use their products to manage some of their internal services. So overall, great company and a fantastic product. Over the last few years, they've done really well. 21.7% revenue CAGR since 2023. And if we look at the long-term trend, it's been great as well. We have this really nice revenue arc over the last 10 years. Earnings growth has not been as good, slightly down since 2023. But what's worth noting is that their free cash flow growth has tracked revenue really well. If we look at free cash flow over time, we have this really nice trend as well. That's translated into them having a much stronger financial position. Negative net debt, that means that they have more cash on hand than the debt they hold on their balance sheet. That's very good. And so overall, they've demonstrated strong revenue performance and strong cash conversion in recent years. A free cash flow margin of 34.5% and a cash conversion ratio of 3.1. That's pretty elite performance for a software company. Now, a couple of things to note. On earnings, you'll notice this big jump in 2023. That was due to a tax advantage that they exercised. It's something known as a valuation allowance. And basically what it means is that while they were unprofitable, they had been racking up tax credits from previous losses and basically saving those credits to use later on. That resulted in a $1.1 billion one-time discrete tax benefit. So this is why earnings jumped a lot in 2023 and then subsequently dropped off. It's because of that one-time tax benefit. And so now things look a little flat since 2023, even though revenue has been growing at about 22% annually. So the main point is this: if you take away that $1.1 billion one-time gain in 2023, the earnings look a lot more stable than what the GAAP figures show. However, at the same time, even after that adjustment, earnings growth lags revenue and free cash flow growth. It was about 20% compared to that 22% revenue growth and 28% free cash flow growth. Now here's why that is. First, ServiceNow is using its cash to reinvest heavily in AI. That means NVIDIA chips, AI research, and new acquisitions. Now these are things that the company has to keep spending on because of the changing environment, so that's understandable. But here's the other reason net income hasn't grown as well. ServiceNow still spends about 35 to 40% of their revenue on sales and marketing to expand subscriptions and upsells. And when you account for stock-based compensation, which they also do a lot of, that number jumps up to about 50 to 55% of revenue. That's a lot for a company that's 20 years old. Now, what makes this a little more justifiable is that their software is expensive. It entails multi-million dollar annual commitments. And so if you're going to sell this type of high-end premium product to people, you have to convince them to pay for it. That's just the nature of the business. What's also justifiable about this spending is that their investments have actually been worth it because they have a very high retention rate. Their retention rate is about 98%. And that basically means that once they've gotten one of these big companies on their platform, the customer rarely ever leaves. That allows them to maximize the lifetime value of their customers. Their LTV to CAC ratio is higher than 5-to-1. What that means is that for each customer on average, they earn more than 5 times back what they paid to get that customer. That's quite high for software. Usually in software, an LTV to CAC of 3 times is pretty good. So thus far, the aggressive sales and marketing strategy is working, but it does come with risks, and we'll talk about some of those later on. Now, the very last thing to note on their historical performance is their gross margin trend. We see here that gross margins increased pretty steadily until last year and then dropped off slightly. This is because it's become more costly for them to run Now Assist as well as their new AI agents. They've had to move away from using standard servers to using more expensive NVIDIA GPUs. And they've also had to increase investments in their own data centers and cloud capacity. So their product is becoming more expensive to provide. Now, as you can see, the margin drop is slight, so we don't want to be nitpicky, but in general, this is ideally something you don't want to see. So looking forward, analysts expect revenues to continue expanding. Revenue growth in 2026 is expected to be 21.2%, then 19.3% the next year, and then a bit lower leading up to 2028 for a total CAGR of 18.3% over the 3-year period. So revenues are expected to grow, but as you can tell from the numbers, that growth is decelerating. It's lower than the 22% growth they posted in recent years. Now there's a few reasons analysts expect this deceleration. The first is that ServiceNow is a pretty big company, and it just becomes more difficult to maintain high growth rates like this past a certain size. That type of deceleration is normal. There's really nothing alarming about this. They've already captured the vast majority of their ideal avatar, the Fortune 500 company, and there's less room for them to grow in that core segment. But the other reason is a bit more alarming. If you think about what ServiceNow does, it sells AI and productivity software to companies, and it charges companies per seat. That means that their pricing depends on the number of power users in the company who use the platform. But as AI continues to automate work, companies will reduce their headcount. They'll need less IT and HR workers, which also means they'll need less seats to pay ServiceNow for. So this is a bit of a conundrum for the company, because the more effective their software is at automating workflows, the more companies will lay off workers, and they'll need fewer seats for the Now platform, which means less money for ServiceNow. So the way ServiceNow is dealing with all of this is to shift to a consumption-based pricing model. That means they're charging customers for AI tokens and actions rather than per seat. This is a pretty fundamental shift in the way the company plans to make money. And the big unknown is how attractive this new pricing scheme will be to customers and how much it will affect the top line. But what we do know is that it will affect the top line in some way, because ServiceNow plans on converting 50% of any new business to this consumption-based pricing model. Now on the positive side, because ServiceNow uses its own software to run its business, it's actually going to become a lot more productive as an organization. So even though revenue growth is expected to decelerate, operating margins are going to continue expanding and net margins are going to improve significantly as well. That should translate into better bottom line growth. So EPS growth is expected to be quite robust going forward. All right, so what does ServiceNow need to do to ensure that the thesis plays out in its favor? Well, the first obvious one is AI integration. We're now living in the age of AI, and there's significant pressure on all organizations, especially software firms, to leverage generative AI to enhance features and product capabilities. So ServiceNow is investing heavily in AI research and development, and they've also spent a lot on new acquisitions. In the last few months, they've spent about $11.6 billion to acquire 3 companies that are expected to enhance their suite of AI capabilities. These companies are Moveworks, Armis, and Visa. And each of them is expected to make the Now platform more capable from an AI and intelligence perspective. Now, so far, we see these investments in AI development paying off. In the last quarter, revenue grew by 19% year over year, which exceeded expectations. And much of that was driven by better than expected adoption of their AI native products. Now Assist adoption surpassed expectations, and so they've actually increased guidance for their AI revenue. The new consumption-based pricing model that we were talking about, charging customers based on usage rather than seats. So thus far, that model has been working really well. And as mentioned, they raised guidance on expected revenues from this pricing shift from $1 billion to $1.5 billion. Again, that's because customers are using their AI products and features much faster than they expected. So in terms of the present performance, things are going really well for them, and they're doing a good job of leveraging their core strengths to defend their position. Going forward, that remains a priority for them. They need to continue investing in AI development and integration, and they also have to continue executing on that aggressive sales strategy. Their future growth is largely dependent on how successful these efforts will be at creating returns. But there are a few risks and flags to point out regarding the thesis. And the first is this. Just because they're doing a good job right now doesn't mean that things will be super easy for them in the future. AI is changing the world really quickly, in real time, and we're still very early on in AI adoption. 2026 is really the first serious year that companies are investing in and leveraging AI to enhance workflows. 2025 was the learning year. 2026 is becoming the true implementation year. And so there's a lot of pressure on companies to spend lots of money to make sure they get it right. So ServiceNow's recent performance in AI revenues makes perfect sense. Companies are obsessing over AI, and they're right now willing to spend abnormal amounts of money on it. The big question is whether that behavior will persist going forward, or will companies actually learn that those additional expenses in AI actually outweigh the benefits? Or alternatively, will new cheaper alternatives arise? We don't know. This whole situation is extremely unpredictable. And that latter point is really the X factor that's going to determine the future of ServiceNow's business model as well as the future of the software industry in general. Many people think that the recent sell-off of software stocks is irrational panic, and that people actually believe that AI is going to completely kill software. I don't think AI is going to eliminate software entirely. I think software will always have a place in society. But what I'm almost 100% certain of is that software is going to become far less valuable as a product. That's just economics. When the barriers to entry in an industry come down, people rush in and they start competing on price. AI is the biggest barrier to entry collapse that the software industry has ever seen. And so the question we need to ask ourselves is, does this actually matter for a company like ServiceNow? They've got 98% retention. 85% of the Fortune 500 already pays them. They have a deep data moat. And this is the part that most people get wrong when they look at ServiceNow. The answer is, this does actually matter for them. And here's why. The bulk of their growth has never come from landing new companies. It comes from selling more to the customers that they already have. They started as an IT service management company. Then they added HR, customer workflows, strategic portfolio management, and now AI agents. Each new module is millions in additional spend per customer. And the issue is that this model only keeps working if three conditions hold. The first is that each new model has to solve a real-world problem. It can't just be something that they charge customers for. The second is that the customer has to prefer one big bundled vendor over several more focused best-of-breed tools. And the third is that each new model has to stay defensible against competitors. Now AI is pressuring all three of these things at the same time. It's now much cheaper for a small team to build a focused workflow tool that does 80% of what ServiceNow modules do at a fraction of the price. That makes best-of-breed alternatives more attractive than they've ever been in a long time. Now, to be clear, we don't think this killed ServiceNow. They have very real moats. Accumulated workflow data, deep integrations across the enterprise, massive switching costs once you're embedded. However, it does mean that every new dollar of growth is harder to come by than the last one. And that's something we're already starting to see in their numbers. They continue to spend at very high rates. Now here's the second big risk to the thesis. When disruptions like these happen in an industry's competitive landscape, there's not only an effect on business models, but there's also an effect on business valuations. We've had several precedents for this in the past. In the early 1970s, airlines were seen as high-tech innovators. Government regulation kept competition low and prices high, and so investors paid massive premiums for airline stocks because they were the future of global connection. But in 1978, the government stopped controlling routes and prices. That made it much easier for new entrants to come in and compete. That created a race to the bottom, and many airline companies started appearing, and the only way to compete was on price. The result was that the industry's PE multiples collapsed. They went from a growth narrative which commanded high multiples, which were in the 20s and 30s, to a more cyclical value narrative that meant lower multiples, more akin to those in the single digits. And so even though the utility of airlines was growing, even though more people were actually flying, the profitability of the business was being eaten by competition, and the businesses were perceived as being less valuable. Another example is in the late 90s with hardware companies like Research in Motion. They all traded at massive multiples. But when computer hardware became commoditized, those multiples compressed. They got re-rated. Of course, we saw this again in the early 2000s with internet stocks. Companies like Yahoo, which traded in some cases at more than 100 times earnings, started to trade at much lower multiples. So what a lot of people don't seem to fully understand is that the ServiceNow sell-off and the software sell-off in general is not a simple "this is the death of software" reaction. It's a fundamental re-rating of what the market thinks software businesses will actually be worth in the age of AI. Now, the complication is that this re-rating is happening right now. We don't know how far the multiples can get compressed. We also don't know whether the compression is going to be temporary or permanent. These are things that are fairly unpredictable. And so the point is this: if a structural re-rating of software companies is in motion, then what's for sure is that valuations may continue to undergo more stress. ServiceNow is still trading at a 50 times earnings multiple on a TTM basis, and their forward PE is around 21 or so. Historically, airlines, hardware companies, and internet companies all got re-rated far below these levels. Okay, so those are some of the risks to the thesis, and we'll circle back to them in a little bit, but let's quickly move on to key metrics. So first, the company looks pretty financially safe. They have a net cash position, which means they have more cash in the bank than they have debt on the balance sheet. But keep in mind that a lot of that cash is going to pay for their recent acquisitions. They spent about $11.6 billion on M&A. So by the end of the quarter, they'll probably be in a net debt position. So that number right here is going to change fairly soon. Their earnings and revenue growth have been pretty darn good, among the best in the industry. But take a look at their ROIC. Their ROIC is actually weak in the software applications industry. And what that means is that, yes, they've grown the top and bottom line pretty well, but they're spending a lot to get the job done. As we mentioned, they still spend a lot on sales and marketing, and their recent acquisitions are even more proof of the spending. If you're going to spend $11.6 billion on new capabilities, you need those investments to produce excess returns, not just maintain current growth rates. So our algorithm gives them a strong moat score if we look at them just on an earnings and revenue basis. But if we add in that additional ROIC metric, they don't look as good. Finally, on valuation, their stock price does look quite discounted. To get to their fair value, we used a blended multiples approach. We took the 7-year median PE, EV to revenue, and EV to free cash flow multiples in the software applications industry, and then adjusted those upwards based on ServiceNow's immediate peers multiples as well as their own historical multiples. We then took those adjusted trading multiples and applied them on forward earnings, forward revenue, and trailing 12 months free cash flow. Finally, we blended all of those results in a weighted average, and that gives us a fair value of $180. Now, our approach is actually quite generous to them because they've been trading at very high multiples before the stock crashed. So a lot of those upward adjustments we made to the industry median multiples helped their fair value calculation a lot. All right, so we've covered a lot here. Let's quickly summarize everything we talked about and then give our final verdict on the stock. So first, ServiceNow is a great business with a really valuable product. They service some of the biggest and best companies in the world, and they've been growing really well. Their performance in the last few years and their more recent performance as well have been really good. In addition to that, so far the AI boom looks like it's a tailwind for them. However, here are some of the potential cracks in the business and also some of the more fundamental risks that make their business harder to predict right now. The main thing we're not thrilled about with ServiceNow is that low ROIC and the amount that they're spending to maintain those 20% top-line growth rates. ServiceNow is 20 years old, and when you look at these numbers, it's clear that the company hasn't quite gone on autopilot yet. It's still buying a lot of its growth. That's for sure partly because of the business they're in and the type of premium product they're selling, but it's something that gives me a bit of pause regardless. The key metric in investing is a return on capital, and ideally what you want to see is a company that has allocated capital really efficiently over a long period of time. That's what creates a natural compounder. Now this matters a lot because it ties directly into the larger structural risk of the business. ServiceNow's whole growth strategy is a land and expand strategy. Instead of chasing new customers, they keep adding new modules and keep selling them to existing customers. That's worked great for 20 years, but it only keeps working if each new module is genuinely valuable, if customers keep preferring to bundle those modules under a single umbrella, and if each module stays defensible against competition. As we said before, AI is putting pressure on all three of those conditions. The fact that they need to spend $11.6 billion on acquisitions just to keep the module pipeline going is itself evidence that the strategy is getting more expensive to run. Now layer on top of that the fundamental shift that they're making in their revenue model, moving from the per-seat pricing to the consumption-based pricing. Though it's a sensible response to the AI tailwind, it's still a transition the organization has no precedent for, and we genuinely don't know how the top line is going to behave because of it in the long run. Now put that all together, a weak ROIC, a sales strategy that's getting more expensive to run, AI compressing competitive moats across the software industry, and a revenue model that's mid-transition. Any one of these alone is manageable, but the problem is you're hitting all of these at the same time, and that combination is what makes the future of the business unusually difficult to predict. Our rule of thumb is that in general, no matter how attractive a valuation might look, or no matter how strong a business's present performance may look like, if you can't predict the business out reliably, then you might want to pause on the investment. We think that ServiceNow is a great company, and that it will probably do well in the future, and that its stock price will probably rebound. We don't see the company being completely dismantled by AI. That would be a simplistic and foolish view, to be frank. But what we do see are a lot of moving variables that continue to change, and that's what makes the business harder to predict. Warren Buffett had a simple rule, and his rule was to identify the key driver of a business and then try to predict it. The example he often used was Coca-Cola, and the key driver of that business was unit case volume. He saw that one variable as a core driver of the business, and he also saw it as something that was predictable. That's precisely why he invested in the company. For ServiceNow, the key variable is net new annual subscription revenue, which is their renewal rate plus their expansion rate. Their renewal rate is solid, and the stickiness of their platform makes that one variable extremely predictable. However, the expansion rate is not predictable because we don't know how customers in the long run will react to the new pricing model as well as to competitive pressures within the industry. And so again, if you can't predict the key variable reliably, it's really hard to have a high conviction on that investment. All right, folks, so that does it. That's what we think of ServiceNow. If you found this useful, hit the subscribe button below. We'll keep the videos coming your way. And if you're looking for a platform that can help you do all this type of analysis, check out valuearbitrage.com. That's what we use. It's free to sign up, so definitely go check it out. All right, we'll see you at the next video.